Hello friends, it's been a long time since I have posted anything in the group. Since all the topics of fundamental analysis have been covered, so let me now come up with the videos, the small videos in 4 to 5 parts. I will try to cover all the fundamental principles and then later on go to the practicality and the functioning of how to do the fundamental analysis. So till now we have seen how EIC, economy, industry, and company analysis is done. And after that, we saw some components like financial ratios, P&L statement, balance sheet, cash flow statement, and some additional terms. So without wasting further time, let's dive into the financial ratios. So here are the following ratios. Some first the valuation ratios. The first one is the price to earning ratio. As we are aware about the price to earning ratio, it should be less than 15. Why? Uh, Ideally, it is seen that the companies with less than 15 price to earning ratio is considered as reasonably or undervalued. But this varies from company to company and industry to industry. So the stocks like, say for example, Tata LXI. Now this stock is having the P multiple of say 150. So this is a expensive P ratio. But when this P ratio falls to 50 or maybe 70 range, then it is considered as a reasonable valuation for this company. Similarly, Tata Steel and other manufacturing companies are having P ratio less than 10. That doesn't mean they are all are at reasonable or lower valuations. So it depends upon the industry and company. And when you are analyzing this P ratio, don't directly look at just randomly that it should be less than 15. You have to compare it within the industry. What is the trend, industry average, and along with its competitors. So likewise, you can analyze the P ratio. Now next is the PEG ratio. So what is the PEG ratio? It is price to earning growth. And earning growth is nothing but whatever earning have been increasing from last maybe 2 to 3 years. That is called earning growth. So this is a better matrix than PE ratio, and the value should be less than 1. From 1 to 1.5, it is also somewhat reasonable, but if more than 2, it is very highly overvalued. Okay, so PEG ratio is a very good matrix to compare when you are not clear about the PE multiple of the stock. Next is earning per share. This is nothing but whatever total earnings by a company divided by the number of shares. Next is the price to book value. Now, by price to book ratio is nothing but the stock price divided by book price of the stock. Book price is the price as per the book value and book of accounts. This shows the company's value. Generally, the stock price is always greater than the book price. So when you find any company which is having the stock price is nearly equal to book price or the ratio is less than 2, so while comparing other factors, other ratios, if you find that all the ratios are favorable and the price to book value is less than 2, then this is a good uh, valuation and you should buy this stock if other ratios are also favorable. Next is the price to sales ratio. It should be less than 1.5. This shows stock price compared to its sales. So if the price to sales ratio is too high, let's say more than 5, this means the stock price is way higher than the company can generate the sales. So it should be avoided. Next is the enterprise value divided by EBITDA. This ratio should be less than 10, and whatever the ratio is maybe more than 15, 20, then that means the uh, value of the company is way higher than whatever the operational income it generates in terms of EBITDA. So it should be less than 10. Now let's come to the leverage ratios. What is a leverage ratio? Basically, it is nothing but whatever the debt taken out by the company, it is called the leverage to do the business. So first is the debt to equity ratio. It should be less than 1. Sometimes you find that the debt to equity ratio is greater than 1 for some time. This happens when company takes new debt. So for some time this ratio goes above 1, but once the company start generating profit from this loan taken and pay back some loan, so the automatically the ratio cools off and goes below 1. So you have to see the trend also in this debt to equity ratio of last 4 to 5 years or maybe more as per your analysis. Now next is the interest coverage ratio. Now this should be greater than 3. What is interest coverage ratio? Is nothing but earning before interest and tax EBIT divided by interest expenses. So this ratio shows us how efficient is company generating its EBIT to pay its interest expense liability. So if this ratio is higher, that means the more profit is coming and the company is easily able to pay back its interest expenses. Next is the debt service coverage ratio. Now again, this is EBIT divided by total debt it has to service. Again in this, if the company is efficient, it is able to generate enough profitability to pay back its total debt for the year, and this should be above greater than 1.25. Liquidity ratios. Now the liquidity ratios are very important because this ratios tells us how tight or how uh, the company is having the more liquidity or in terms of cash. So if the say for example current ratio, it is nothing but current assets divided by current liability. Now this ratio should be greater than 1.5, but it should be not more than 3. Why it should not be more than 3 or maybe 4? Because the higher the amount of current ratio, that means company is having more current assets than it is required for paying the current liability, and that means the cash is lying idle and company is not utilizing the cash efficiently to generate more income or more profit out of that cash lying around in the banks. Now similarly, quick ratio, it should be above 1 and up to 2.5 to 3, but not more than that. The formula is same, it is just that the on the numerator current accounts current assets minus inventory minus whatever prepaid expenses divided by current liability remains same. Again, more than 2.5 to 3, that means the cash is lying idle in the bank account and there is no income because always the companies are holding the cash in the current account, not the saving account, and there is no interest given by the banks. So the money is lying without generating any other income or profit. So it is a inefficient way of keeping the money. So it should be greater than 1 but up to 2.5. Likewise, current ratio greater than 1.5 up to 3. Now next is the current liability coverage ratio. You can say current debt coverage ratio, CDCR. Okay. So this is basically cash from operations divided by current liability. It should be again greater than 1. Now let's move on to the return ratios. First is the ROE. So what is ROE? Net income divided by shareholders equity. What is shareholders equity? Whatever stocks we hold, it is called shareholders equity. So ROE takes into account how much net income is generated by utilizing the cash collected from shareholders. Likewise, you all know IPO comes, we pay the money, we get the shares. Whatever amount is collected by the company in IPO, this is utilized for the generation of this net income. So this shows how much net income is generated through shareholders equity capital. Now this should be above 15%. ROE is more relevant for BFSI, banking, financial services and insurance sector. However, it is also useful for all other stocks. Next, we move on to the ROCE, return on capital employed. Again, it should be greater than 15%. But the only thing which is different is it is EBIT, not the net income, divided by capital employed. Now, this capital employed consists of debt taken by the company as well, apart from shareholders' equity. So, this is a I would say better metrics where the companies take loan. In the bank's case, they don't take loan, banks take deposit from the customers. So RO is more important. But for the companies like any manufacturing company or any IT company, ROC is more important because they have a component of shareholders equity plus debt. So this is all combines into the capital employed, and whatever EBIT they generate, as per that the ROCE percentage is decided. So higher the ROCE percentage, it is better. Next is ROA. Again, the formula consists of net income divided by average total assets. Now, what is the average total assets? Say, for example, 1st March 2024, 1st, not March, April, start of the financial year. If company is having 600 crores of assets and 31st March 2025, the assets grows to the 700. So the difference is 100 crore. Say for example, the company is able to generate 2000 crore of net income. So if you divide 2000 divide by 100, it comes to 20%. So that means the ROA is 20%. The higher the ROA, it is better. Now next we move on to the turnover ratios. First is the asset turnover ratio, and again this is the higher the better. So what is the full formula for this? ATR, asset turnover ratio, is equal to total sales divided by again change of assets. likewise, like in ROA. So this shows us how much the company is able to use its assets effectively for generating higher sales. So it should be the asset turnover ratio should be higher. Next is the inventory turnover ratio. So let's look at ITR. And what is ITR? It's basically cost of goods sold, or famously known, if you have seen the Shark Tank, they call it COGS, cost of goods sold, divided by average inventory. Now this inventory turnover ratio, again it should be higher. Why? Because if the inventory is piling up, so company is not able to generate enough profits. So if the inventory turnover ratio is higher, that means the new product comes to the inventory and old products from inventory goes for a sale. So this is a cycle, and this cycle should be faster. So interest inventory turnover ratio should be higher. So that's it guys for today. We have covered measure all the ratios which we have learned in the channel, and in the next part we will go for the profit and loss statement. And likewise I'll make 4 to 5 videos, and at the end of the all the videos, the last video will cover how to do fundamental analysis using this screener.in website and its Excel sheet. So stay tuned and keep sharing and subscribing to the channel. Thank you.